Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins, and today we're going to talk about volatility. Volatility in the currency, volatility in the stock market, commodities, gold, you name it. We are entering into a time where markets have seen a significant contraction. Whether this is for example, the correction that I was looking for in the equity markets is yet to be determined. A lot of that will depend upon what happens today and tomorrow. This was recorded on Tuesday morning, April the 16th. I would expect after the significant sell-off yesterday to see some kind of a bounce, but if that bounce runs out of energy towards the close, I would look for a weak opening on Wednesday, which tells me that the correction is not over. If on the other hand we have a significant stronger day and we get a strong close, I would suggest that this is not the correction that I've been looking for. It's a very difficult time. The magnitude of the loss, for example, in the gold market has been unbelievable. Gold prices have dropped $160 an ounce in 2 days. Yes, that's right, $160 in an ounce of gold in 2 days. This morning we had $1,321 an ounce, down from a high of $1,920, almost $600 decline, or a 30+% decline in the value of gold from its high of last year. I have to believe that that's doing an enormous amount of damage. Whether or not the 1,300 level will hold, only the markets will tell us that. There should be some technical support somewhere between $1,250 and $1,300 on the price of gold. Silver has sold off. Some of the other precious metals have sold off. But the decline in gold has tremendous implications. Some of the biggest hedge funds have been very bullish on gold and been extremely long and have been punished all the way through this decline. I'm not sure that they got out before the precipitous decline of last Friday and Monday. If they didn't, their portfolios are under enormous amount of pressure and showing significant unrealized losses. But what is it telling us? Some analysts are saying, well, it's just a matter of the big gold buyers, China and India, have backed away from the market, or is it the possibility that central banks are selling gold to raise money to deal with the debt crisis in Europe, or? I suspect that what might be happening here with the decline in the long end of the U.S. Treasury market, the decline in most of the major currencies against the U.S. dollar, I think that what we may be seeing here is the beginning of something more than a small economic downturn. We may be entering a period of time of a deflation. And that's what the commodities are telling me at the moment. There's a significant price weakness. That means that there's going to be less demand for commodities, and with less demand, prices tend to get soft and fall. Now, there's probably lots of reasons why gold is coming down. But if you look beyond the precious metals and look into the raw commodities, what you're seeing is a general decline in the price of grains and fibers and oil and all kinds of commodities. The one area that has seen a reasonable rally in the face of all this commodity decline is natural gas. It's at about $4.20, up from its bottom of $2.82, so it's had a significant run. We now have West Texas crude in the 80s, and Brent North Sea crude in the low 90s. The implication of a continuing decline in crude oil prices is, while being good for our economy and for the American people, meaning lower gas prices, and we've seen that already. The negative is, however, is that most of the OPEC countries need a minimum of $85 price on competitive crude to West Texas in order to break even. Any break below 85 is going to start to put significant pressure on the Middle Eastern oil countries and the members of OPEC. I read recently that 80% of the people, the workforce in Saudi Arabia, are immigrants, and they're transient. They're not residents, and they work in the pipelines and the oil fields and the service shops. But 80%, which means that only 20% of the workforce in Saudi Arabia are Saudi Arabians. There are 5,000 princes in the kingdom, all with substantial wealth driven off of oil revenue. If oil revenue continues to decline because the price of oil declines, the quality of life in all of these OPEC nations may be adversely affected. Now, they certainly have tremendous currency reserves and can weather a short-term storm. But if we're talking about a fundamental shift that says that the world economy is going to continue to slow and the demand for all commodities is going to reduce because growth rates will slow, then it's going to put significant pressure on the Middle Eastern nations. Those people have depended upon the revenue from crude oil to sustain their economies and their people. If you start burning up all of your reserves and then find yourself in a situation where you can't break even on the price of oil, you're going to have to start cutting services to your countrymen. That's going to create some political unrest, and in the Middle East, it doesn't deal too well with political unrest. In the United States, I think there's going to be continued revisions downward in what the expectations for GDP will be for the rest of the year. And I think that we're going to see perhaps some further downward pressure, flattening of the yield curve, if you would, to even lower intermediate and long-term rates. Now this morning we have the 10-year at about 168, the 30-year about 291. I think it's possible that under the right set of circumstances, you could see a 1.25% yield on the 10-year and probably close to 2.25% on the 30-year. So there's significant opportunity for appreciation, or perhaps not, but the risk of trying to gain that extra small amount of total return is going to be extremely high. Because if this economy starts to pick up later in the year, the Fed is going to be predisposed to start a dialogue at least about when it's going to start increasing rates and taking off quantitative easing. There could be a huge reversal in the bond market. So those people who are saying it's time to get out of the Treasury market, I'm not sure I agree with their timing, but I do agree that there's tremendous risk in the long end of the Treasury market. You don't get paid anything in the short end, so what you're seeing is a demand push with all the political turmoil around the world. It was interesting to see when Japan made the decision, central government, to reinflate its economy. People were lined up around the blocks to taking their money out of Japanese banks and put it in U.S. treasuries. Even though there's practically no return in short term, the Japanese people feel that there's perhaps more currency risk in Japan than having U.S. treasuries at very low rates of return. One final thought. It's not an investment per se, and that's the discussion about what's going on in North Korea. It's interesting, some political pundits say that America is more concerned about what's happening with Iran and their nuclear program as opposed to North Korea. North Korea can and already is an unstabilizing force in Southeast Asia. It'll be interesting to see how things play out if the leadership of North Korea continues to rattle their swords or takes any action against South Korea or Japan. What the ramifications are going to be politically and eventually economically for the rest of the world. I think that's an area we have to spend a great deal of time watching and trying to work around. It's certainly possible that Iran may have getting closer to building a nuclear device, but I think there's enough defense mechanisms in the Middle East to deal with that. North Korea is a different situation. Bigger country, bigger economy. Granted, they're spending all their money on defense and not feeding their people, But I think with the instability of the dictator who's running that country, they could be a very, very strong destabilizing force and create havoc in Asia, which would have a significant impact on the global economy. And maybe that's what we're seeing in the market, is a concern that the saber rattling in North Korea turns to be more than that, and we have total instability in Asia. We have one of the largest markets in the world with China, and Japan trying to rebuild itself. You could have significant long-term economic consequences if the saber rattling turns to something more constructive or destructive. So, wish I had better news. I continue to watch the portfolios, and we have cash looking for opportunities to invest. When I see it, I'll do it. If you have questions, please feel free to give me a call or send me an email. And as always, if you have somebody who's looking for better returns, lower costs, and personal service, give them my number and let me talk to them. Thanks for watching.